Everyone, how are you all? Welcome back to my channel Krishna Singhdeo. So today we are going to do one very important chapter for class 12 which belongs to management accounting. Whether you belong to CBSE board, you belong to ISE board or you belong to any other board, this chapter has equal importance for all of you. So today we are going to start one chapter called ratio analysis. Ratio analysis is part of management accounting under which you do take out ratios of various items of balance sheet and various items of income and statement accounting. So, in income and statement account. So, over here you understand what is the relationship between various items of balance sheet and income and statement account, and based on the ratios you do some interpretation and analysis also. This particular topic you are going to study in your higher education as well. This is part of financial management. So, you may read this chapter later on also somewhere, study this chapter later on also somewhere in your graduation or any other professional course. There also the knowledge gained at this stage is going to be very, very handy for all of you. So let's get started. First of all, I am going to start with liquidity ratios. Before we understand liquidity ratios, let's see what is the purpose of finding out liquidity ratios and what is the standard liquidity ratio considered to be good and what is the ideal amount of this ratio should be there. So for that, I am going to share with you one very amazing sheet which is prepared by me and my team by taking help from various authors which are there for class 11 and 12, and this sheet is available on my app free of cost. So you can download Krishna's classes, and under Krishna's classes and the free study resources, this sheet, formula sheet, is available to you, and believe me, this formula sheet is very, very helpful for all the students who want to take their studies to next level for this chapter. This chapter is based entirely on formula, and one more thing, the balance sheet of companies is going to be very, very essential to be learned before doing this chapter. So I'm assuming that all of you will do this before attending the lectures over here. If you have not yet done balance sheet of companies, do revise from your book and then see this chapter. It's going to be very helpful for you because you will have a better understanding of this chapter. So let's get started, students. So here is the formula sheet about which I was talking about. This is very, very helpful sheet for all the students who want to practice ratio analysis chapter, and you can get it for free of course. Let's see. First, we have liquidity ratios. Under liquidity ratios, how many ratios are there? Under this particular head, liquidity ratio, which checks the liquidity position of the company. Liquidity means short-term liquidity, how much cash is available with the company to pay off its short-term loans and other kind of debts. For that, we take out two kind of ratios. Number one is called current ratio, and number two is called liquid ratio or quick ratio, and it is also called asset test ratio. So let's see one by one what comes under current ratio and what comes under liquid ratio. So the formula of current ratio is current assets upon current liabilities. So we see the relationship between the current assets and the current liabilities. What do we see? That how many times more the current assets are there to meet the current liabilities. I am sure that you know by now what are current assets and current liabilities. Current assets are those assets which are to be paid off, which are to be liquidated in the cash again within a period of 12 months or whatever is the operating cycle. And at the same time, what are the current liabilities? Current liabilities are those liabilities which are to be paid within the period of 12 months or the operating cycle. So current liabilities and current assets, first of all, we should know what are the current assets and current liabilities. We'll pick up that and put it over here in the ratio. And what do we get? Why are we calculating this ratio, which is very important to know? So the ratio shows that short-term financial soundness of the business. Higher ratio means better capacity to meet current obligation, and the ideal ratio is 2:1. But remember one thing, too much of liquid in hand is also not good. So too high ratio is not considered to be good. It means your cash is big item. Then the next important thing, how this ratio is expressed. So always this ratio is expressed in the payoff form like 1:1, 2:1 or something like this. Okay, and then the description is given over here for those who still have some doubt that what are current assets and what are current liability for you, your problem is being taken care over here. In the formula sheet only it is written what are current assets and current liabilities. So various examples of current assets are given, and one very important thing is being mentioned. So current assets means current investment. Inventories. About inventory, something very important is there. When you study balance sheet chapter, you are being taught that loose tools and spare parts are part of inventory only. We do not write them as separate asset. Instead of writing as an asset, we include them in the inventory. But when you calculate current assets, you exclude those items from your inventory, means you do not take care spare parts and loose tool while calculating current ratio as your current asset. So be careful about this point, that if it is written in the question that inventory and part in this it is included that spare parts are also there and loose tools are also there, so just deduct that amount, because you do not want spare part and loose tools as your inventory. You want your pure inventory which will be sold and cash will be received from your debtors or from your customers. Then the next one is trade receivables. Trade receivable means under which your bills receivable and your debtors come. So net of trade receivable is required. Why net of trade receivable? Because trade receivable is always written like this. Let me share with you. When you study balance sheet, how do you see the trade receivables are written? In the balance sheet, you see the trade receivable are written something like this. You will see debtors. In note to accounts, you see sundry debtors. X amount is written over here, and then what do? We deduct provision for doubtful debt. Then in the outer column, you see the final amount written over here. So what do we want? We do not want this amount. This is called gross debtors. We do not want gross debtor. This amount, which is called net debtor, we require this amount. This is called net debtors. Okay, so we require net trade receivables or net trade debtors. Okay, now let's come back to the formula sheet and see what else is important about this. So you have cash and cash equivalent, then short-term loans and advances. You must have seen there are two types of loans and advances. One is long-term loans and advances, which comes under non-current assets, and another one is short-term loans and advances. Short-term loans and advances are current assets. It is taken over here. Then other current assets. Under other current assets, any kind of prepaid expenses, etc., that all comes. This is also taken over. Then what comes under current liabilities? Under current liabilities, you have short-term borrowings, you have trade payables, you have other current liabilities and short-term provisions as well. So all these things are your current liability. I hope now this is very clear to you what is current assets and current liability. But not only this, there are few more things which are required to calculate the liquid ratio and current ratio. That is knowledge of working capital. What is working capital? This also we must know. So let us understand what is the formula of working capital. Then we will move to quick ratio or acid test ratio. So working capital, I'm sure you all must have studied in your theoretical subjects, business studies or commerce, working capital, and you must have studied management of working capital as well. So working capital is that amount of capital which is required for day-to-day functioning of a business. Means the capital which is required for paying the wages, for buying the raw material and any other expenses to be met, which is not a capital expenditure, which is a recurring expense. So working capital, how do we calculate? We normally say working capital is excess of current assets over current liability. So we can say current assets minus current liability, or excess of current assets over current liability is called working capital. So this formula is also very important formula, because in most of the ratios, question of the ratios of current ratio and liquid ratio, working capital will be given and one of the figure will be missing. Means either the current asset will be missing or current liability will be missing, and you are supposed to take out that with the help of working capital. Question will inform you about the working capital available to the organization. So this is also one important formula you must understand and learn by doing the solvency ratio, short-term solvency ratio, or which is called liquidity ratio. Now let's see the next type of ratio. What is next ratio? The next ratio is liquid ratio or acid test ratio. These two ratios are called liquidity ratios. So we have dealt with the first one, what is current ratio. Now the next one is liquid ratio or acid test ratio, and it is also known as quick ratio. So the formula is liquid assets or quick asset upon current liabilities. As far as liabilities part is concerned, all current liabilities are moving into numerator. So denominator in both the ratios, in current ratio and in liquid ratio, is going to be same. But when we talk about the numerator of both the ratios is not same. Numerator of quick ratio is quick asset. Now the question arises, what are quick asset? How do we find out quick asset? So see what happens when you find out current ratio, where this ratio tells what is the liquidity position or short-term financial soundness of an organization. But still, there are certain things which will take longer period of time to be converted into cash. For example, inventory. Inventory will not get converted into cash immediately. Why? Because you will have to find out the buyers, and obviously the manufacturer would not like to sell inventory at any cost offered by the buyers. You would always wait for the good prices. So it may take some time to convert inventory into cash again, and which may be used more than the period which is required for converting it into the cash. That is why it is not considered quick ratio. It is not considered while calculating quick ratio. What is the meaning of quick ratio or acid test ratio? Acid test ratio means if you use two chemicals and you want to see the reaction, you won't have to wait for the reaction to be seen. Immediately, as soon as you mix two chemicals and you put them together, you will find the result instantly. Similarly, if you want to know instantly how much cash is available, you should not include inventory, because inventory is going to take some time to be converted into cash. Similar thing is with any kind of advances paid to the people in form of expenses. So these are called prepaid expenses, because if you have paid it to someone, it is going to be very difficult to get that money back from someone, and even if the person is ready to give, they will not give you immediately. They are going to take their own time. So here also the convertibility into cash is not immediate. That is why these two items specifically, one inventory and second is prepaid expenses, are removed from the current assets while calculating quick assets. So what is the formula of finding out quick asset? The formula of finding out the quick asset is current assets minus inventories and minus prepaid expenses. When from current assets these two items are excluded, this is called quick asset. And as far as current liabilities are concerned, it is same as in the previous ratio. Current liabilities means any kind of sundry debtor, and sundry creditors means trade payables, outstanding expenses, any kind of short-term loans, etc. All that is your current liability. Now let us see what is the purpose or significance of calculating this ratio. So liquid ratio is fairly stringent measure of liquidity. It is based on those current assets which are highly liquid. So we have just excluded those assets which will take some more time to be liquidated. Highly liquid assets are taken, inventory is removed, prepaid expenses are removed. It can be converted into cash and cash equivalent quickly. Quick ratio is 1:1. Ideal quick ratio is 1:1, considered as ideal. Higher quick ratio better, higher the quick ratio better, and short-term for the short-term financial position. Okay, and this ratio is also a pure ratio. It is also expressed in 1:1 or something like this. In this form only this ratio is expressed. I hope this is clear to you all the students, that how do we find out current ratio and how do you find out the liquid ratio. Now I know this itself is not enough. Until you practice some of the question, this is not going to be enough. So for practicing the question, we will meet again in the second video, where we are going to complete the numerical part of this. We will solve many questions, and the trickiest questions which are possible for current ratio and liquid ratio we will take. And let me tell you one more very interesting thing and very helpful announcement for all of you, that this entire chapter, ratio analysis for class 12, I am going to take up, and the book which I will be following is T.S. Gilawal sir. I will be following T.S. Gilawal sir's book, and I will solve maximum number of questions possible for you all over here. The videos will come on the regular interval, so you can keep following me, and we will together complete the entire chapter. So today the starting has been done. We have started what is liquid ratio and what is current ratio. Theory part is done. Now we will meet again in the next video, and we are going to start the numerical questions for this particular chapter. Have a great day, students, and if you think that this video is helpful for you, don't forget to share it with your friend and give a like to this. And if you have not yet subscribed my channel, don't forget to subscribe my channel. And downloading my app is equally important, because when you download my app, you will get access to a lot of free study resources and other paid courses which are available at very, very reasonable prices for all of you.